All right, today we're going to play doctor. But our patient isn't a person, it's a company. We're going to give it a complete checkup and see what's really going on under the hood.
So, think about a company you love. You know, the one that makes your phone or maybe your favorite pair of sneakers. Is it actually as healthy as it seems on the outside, or is it secretly struggling? It's a really interesting question, and believe it or not, the answer is out there for anyone to find.
You see, every public company has to publish what is basically a health report every single year. Okay, they're not actually called health reports, they're called financial statements. But honestly, the idea is exactly the same. They're the best way to diagnose the health of a business.
Now, to read this report, you first have to understand the language it's written in. Don't worry, it's not that complicated, but it is specific. It's the language of business, and it's called accounting.
Financial accounting is pretty much the medical science behind our company checkup. It's this standardized system for tracking where every single dollar comes from and where it goes. It translates all that activity into a clear story so that people, investors, banks, and yeah, you, can make smart decisions.
This company health report is really built around 4 key documents, but we're going to focus on the big 3: the balance sheet, the income statement, and the statement of cash flows. Just think of each one as a different kind of diagnostic test at the doctor's office.
Let's start with 2 of the most important ones. You've got the balance sheet, which is like a financial X-ray. It's a snapshot freezing a company in a single moment to see its structure. But then you have the income statement. That's more like a stress test. It shows you how the company performed over a period of time, like watching a video of it running on a treadmill for a whole year.
So let's start with that X-ray, the balance sheet. This is where we get to see the fundamental building blocks of the company. And it all boils down to 3 key things.
First up, assets. This is all the valuable stuff the company owns. We're talking about the cash in its bank account, the factories and computers it uses, any products sitting in a warehouse. It's the company's stuff pile.
Next, we have liabilities. And this is pretty much the opposite of assets. It's everything the company owes to other people. Think of bank loans, bills it has to pay to its suppliers, any kind of debt. This is the IOU pile.
And finally, there's stockholders' equity. This is what's left for the owners after you pay off all the company's debts. You just take the assets and subtract the liabilities. It represents the owner's true stake, their piece of the pie.
And here's the really cool part. These 3 things fit together perfectly in the basic accounting equation. Assets must always equal liabilities plus stockholders' equity. It has to balance. I mean, think about it. Everything a company owns was paid for in one of 2 ways, either by borrowing money or by using the owner's money. The 2 sides of that scale have to be perfectly level.
Okay, so the X-ray gives us a static picture. Now it's time for that stress test, the income statement. This isn't about what a company owns, it's about what it has achieved over a stretch of time. The income statement really answers one simple but incredibly powerful question. Over a specific period, like last quarter or last year, did the company actually make money or did it lose money? It's all about performance.
And the math here is beautifully simple. You take all the money the company brought in, that's called its revenues, and you subtract all the costs of doing business, its expenses. This one little calculation tells you everything about the company's profitability for that period.
What's left over is called net income, or what you've probably heard called the bottom line. If it's a positive number, great. The company was profitable. If it's negative, well, it took a loss. This is one of the most watched numbers in the entire business world, for sure.
Okay, so we've got our X-ray and our stress test, but any good doctor will also order some blood work, right? You got to see what's really flowing through the system. For a business, that lifeblood is cash, and we track it with the statement of cash flows.
This report breaks down all the cash coming in and going out into 3 simple categories. You've got cash from operating activities, that's from the main day-to-day business. Then there's investing, that's cash from buying or selling big-ticket items like buildings. And finally, financing, which is cash from investors or banks.
So why is this so critical? Because a company can look profitable on paper, with a nice positive net income, but still go bankrupt because it flat out ran out of actual cash. This statement cuts through all that. It reveals the truth. Is the business a cash-generating machine, or is it bleeding money?
Now you might be thinking, okay, this is all great, but how do I know these reports are even true? That's a fantastic question. There's a whole system of rules and, referees in place to make sure the diagnosis is accurate.
It all starts with a rule book called GAAP. Just think of it like the official medical textbook for accounting.
Every public company has to follow these exact same rules, which means investors can compare the financial health of two different companies and know they're looking at apples to apples.
And on top of GAAP, there are 3 key layers of protection. First, companies have their own internal controls to double-check everything. Second, they have to hire independent auditors to give a crucial second opinion. And finally, there's a special committee on the company's board that oversees the entire process to make sure everything is transparent and accurate.
So when you look at a real financial statement, you're not just looking at a page of numbers, you're looking at a document that's backed by some seriously strict rules and multiple layers of oversight. And that's what gives investors the confidence to put their hard-earned money into a business.
So, there you have it. The balance sheet gives us the X-ray of the company's structure. The income statement is the stress test of its performance. And the statement of cash flows is the blood work, showing us the real-life flow of cash. Together, they give us a pretty comprehensive health checkup.
This information isn't a secret, it's all public. Every company you can invest in has one of these reports available online. So now that you know how to read them, the only question left is, which company's health are you going to check first?
All right, welcome everyone. Today, we're going to crack the code on one of the most powerful tools in business. It's a single page that can tell you a company's entire financial story in a single snapshot, the balance sheet.
But first, let me ask you something. Do you think it's possible to really judge a company's financial health, its strengths, its weaknesses, in just 60 seconds? It sounds almost impossible, doesn't it?
Well, the answer is a huge, resounding yes. You absolutely can. And the secret? It all lies in understanding the simple, elegant logic of the balance sheet. Honestly, it's the financial world's most powerful cheat sheet. Okay, let's break this down. Really getting the balance sheet just comes down to 3 core ideas. And it's all about the simple difference between what a company owns and what it owes. So first step, we have assets. Now, the official definition can sound a little academic, so let's just think of it this way. Assets are simply all the valuable stuff the company owns. That's everything from the cash in its bank account, to the computers on its desks, to the inventory in the warehouse, even the factory it operates in.
Next, you've got liabilities. These are basically the claims other people have on all that stuff. In plain English, liabilities are everything the company owes. This could be a bank loan, bills it hasn't paid yet, or the salaries it owes to its employees.
And finally, the third piece of the puzzle, stockholders' equity. This is what's left over for the owners. So, if you took all the company's assets, sold them off, paid back every single liability, the cash that's left in your hand, that's the equity. It's the owner's true slice of the pie. So, the most important thing to take away is this really simple relationship. Assets are what a company owns. Liabilities are what it owes. And equity is what the company is really worth to its owners. Owns, owes, worth. Just remember that. Now, here's where it gets interesting. These 3 parts aren't just separate ideas. They are locked together. They're connected by one simple, incredibly powerful, and totally unbreakable rule that is the foundation of all accounting. And there it is. Assets always equal liabilities plus stockholders' equity. This isn't just a guideline. It's the fundamental accounting equation. It's like the law of gravity for finance. Every single transaction has to obey this rule. And this is exactly why it's called a balance sheet. The 2 sides of the scale have to be equal always. Everything the company owns has to be accounted for by who has a claim to it, either the creditors, which are the liabilities, or the owners, which is the equity. And that ratio tells a really important story. A company that's funded mostly by equity, it's probably on pretty solid ground. But one that's funded by a whole lot of debt, well, that might be a riskier situation. So you're probably wondering, how does this actually work in the real world? A company is never static, right? It's always buying, selling, borrowing. So how does this equation stay perfectly in balance when everything is constantly changing? Well, the key thing to remember is that every single business action has a dual effect. You can't just change one thing. For example, if a company buys a new truck with cash, one asset, the truck, goes up, but another asset, cash, goes down. The equation stays perfectly balanced. Or let's say it buys that same truck with a bank loan. Its assets go up, but so do its liabilities. Again, perfect balance. Every action has a reaction. And to track this constant juggling act for every single thing, accountants use a really simple but powerful tool called a T account. It's called that because, well, it looks just like the letter T. One side tracks increases, the other side tracks decreases. It gives them a clear visual way to make sure every change is recorded correctly and that the big equation always stays in balance. It's the building block of financial accuracy. Okay, so we've got all these individual actions and the T accounts that track them. But how do all these thousands of tiny transactions come together to create that one final clean report we started with? It all happens through what's called the accounting cycle. This is basically a standardized process that takes all the chaos of daily business transactions and just methodically records, adjusts, and summarizes them. The single goal of this entire cycle is to produce that one clear, final snapshot of financial health, the balance sheet. And there you have it. Once you understand that simple relationship between what a company owns, what it owes, and what it's worth, you have the key. You can unlock the financial story of any business out there. It's a code, and now you know how to read it. So the only question left is, what stories are you going to find? A story of explosive growth? A company buried under a mountain of debt? Or maybe, just maybe, an undiscovered gem that no one else has seen yet? The balance sheet holds all the answers. Okay, so every company out there tells a story with its numbers. And today, we're going to learn how to actually read that story. We're diving deep into one of the most important chapters of all, the income statement. So let me ask you a big question. How do you really know if a company is profitable? I mean, it seems like a simple question, right? But the real answer? Well, it's a little more complicated than you might think. We're going to look past all the headlines and all the hype to figure out what's actually going on with a company's money. And to make this all make sense, let's grab a real-world example, a company we all know, Chipotle. I mean, you've seen the lines, right? They're obviously selling a ton of food. But here's the thing. Do massive sales automatically equal massive profits? Let's dig in and find out. All right, to get to the bottom of this, we need an official tool. And our investigation is going to start right here with what's called the income statement. And here we go. This is what one looks like, a real income statement for Chipotle. Now, I know it might look a little intimidating at first, but honestly, the best way to think about it is like a report card. But instead of grades, it uses dollars and cents to score the company's financial performance over a specific period, like a quarter, or in this case, a whole year. So everything kicks off right at the very top with something called revenue. This is simply all the money a company brings in from its main business. For Chipotle, that means the total value of every single burrito, every bowl, and yep, every side of guac they sell. Of course, you know the saying, you gotta spend money to make money. Well, that's where expenses come in. These are all the costs of doing business. For Chipotle, we're talking about everything from the avocados and chicken to paying their employees to just keeping the lights on in the restaurants. And this brings us to the part everyone always talks about, the famous bottom line. When you take the total revenue from the top and you subtract all of the expenses, whatever is left over, well, that's the net income. That is the company's actual profit for the period. Now, all this seems pretty simple, right? Money in minus money out. But, it's not quite that easy. Turns out there are some very strict rules for when you're allowed to count that money, and those rules change everything. So you gotta wonder, what's the trigger? Is it when a customer actually hands over the cash? Is it when they place an order? Or is it something else entirely? Believe me, the timing is absolutely critical, and it can dramatically change the whole story the numbers are telling. Well, there are two main ways to answer that question. First, there's cash accounting, which is super simple. You record a sale when you get the cash. But most big companies use something called accrual accounting, and it's far more accurate. It records revenue when the company has earned it, which isn't always the same moment the cash actually changes hands. This is all governed by a core rule called the revenue recognition principle. And it's a simple but really powerful idea. You can only count the money when you've held up your end of the bargain, when you've actually delivered the goods or services you promised. And this is exactly what it means in the real world. A customer might pay online, or at the counter, or maybe it's a huge catering order and they get an invoice later. It doesn't matter. For the accountants, Chipotle only earns the revenue at the exact moment that burrito is delivered. That's the key event. Now, a burrito sale is pretty simple, but what about a multi-year software contract? To handle those really complex deals, accountants follow this official 5-step model. We won't go through every single detail, but it's basically a system to make sure revenue only gets counted as each part of the promise is fulfilled. So what about the costs? Yep, there's a rule for that too, and it's often called the matching principle. It dictates that you have to record the expenses in the exact same period as the revenue they help generate. So the cost of the chicken has to be matched with the sale of the chicken burrito in the same financial report. Okay, so we've got the rules, but how does selling one burrito actually translate into a number on that final income statement? Let's kind of trace the journey from the cash register all the way to the report. Every single transaction, and I mean every sale, every salary paid, every bill that comes in, is first recorded as something called a journal entry. It's kind of like a financial diary, a chronological log of everything the business does. These entries are the absolute fundamental building blocks. Then, at the end of a period, all of those diary entries are collected into this master list called a trial balance. It's basically a quick check to make sure the books are balanced before creating the final reports. You can see the entries for revenue and expenses right here. This is the raw material that gets organized and summarized into that clean, simple income statement we saw earlier. Okay, we've covered the rules and we've covered the process. But let's get back to the most important question of all. Why should you care about any of this? Well, let's boil it down. First, accrual accounting just gives you a much truer picture of a company's health. Second, the income statement is like a movie, not a photo. It shows performance over time. And this one is the big one. These rules create a level playing field. It means we can confidently compare Chipotle's profitability to, say, Starbucks, because we know they're all playing by the same rulebook. So, here's the crucial point. An income statement isn't just a list of numbers. It's a whole narrative, and it's crafted according to a very strict set of rules. And when you understand those rules, you can read between the lines and see the real story of whether a company's business model is actually working. And that's the income statement, a really powerful tool for understanding a company's past. But it does leave us with a critical question. If this document perfectly captures where a company has been, what clues about its future might it be leaving out? Something to think about. Thanks for joining me.
You ever think about accounting as storytelling? Seriously, it's not about making stuff up. It's about telling the true story of how a business did, over a month or a quarter. And just like any good story, accounting has a kind of grammar, a set of rules that make sure the narrative is accurate and makes perfect sense.
Okay, let's make this real. Imagine a client loves your work so much they pay you $12,000 for a whole year of service, right up front. That cash is sitting in your bank account looking great. But here's the question. How much of that did you actually earn this month?
Now, if you're just looking at the cash, the answer seems simple, right? You got 12 grand. But does that really tell the story of how your business performed this month? Nah, you've only delivered 1/12 of the service. You still owe your client 11 more months of work. And that gap, right there, between the cash in your hand and the value you've actually delivered, that's the central conflict in our financial story.
So, how do we fix this? How do we tell the right story? Well, we use a framework called accrual accounting. And honestly, the best way to think about it is as the official rulebook for financial storytelling. It gives us the rules to make sure every single transaction gets recorded in the right time period. Or, to stick with our metaphor, in the right chapter of the story.
And it really all boils down to two golden rules. First up is the revenue recognition principle. This just means you only count revenue when you've actually earned it by delivering the goods or services. The cash part is irrelevant. Second, we've got the expense recognition principle, sometimes called the matching principle. Here, the idea is to record your expenses in the same period as the revenues they helped you get. These two rules together, they make sure our story is about what really happened, not just when money changed hands.
Okay, so just like any good writer, we are not publishing the first draft. At the end of each month or quarter, we have to go back and edit our financial story. This whole editing process involves making what are called adjusting entries to make sure every last bit of revenue and every single expense ends up in the correct chapter.
Our first big edit is for something called deferred revenue. Sounds kind of technical, but it's simple. This is cash you've been given for work you haven't done yet. I know it feels like income, but in the world of accounting, it's actually a liability. It's a promise you have to keep to your customer.
And boom, this takes us right back to our opening question. That $12,000 upfront fee is a textbook example of deferred revenue,
So after 1 month, you'd make a little adjustment. You'd move just 1/12 of that money, $1,000, from the liability column over to the earned revenue column. And now the story is accurate. So what's the flip side of this? Well, that's called accrued revenue. This is the complete opposite situation. This is money you have absolutely earned. You did the work, but you haven't gotten paid yet. You might not have even sent the invoice out.
Just picture it. You finish a huge project on the 31st of the month. You earned that money this month, so the story of this month's performance has to include it. You make an adjusting entry to record that revenue right now, even if the cash won't show up till the next chapter.
All right, we've covered revenue, so let's look at the other side of the story, expenses. First up, we've got deferred expenses, which you might also hear called prepaid assets. This is just when you pay for something way in advance. The cash is gone, but you haven't really gotten the full benefit yet.
The classic example here is your annual insurance bill. You pay for 12 months of coverage all at once, but you only use up, right, 1 month of that benefit at a time. So every single month, an adjusting entry moves 1/12 of the total cost from being an asset to being an actual expense. That way, you're matching the cost to the period it actually covers.
And our last edit is for accrued expenses. These are costs your business has already racked up, you've gotten the benefit, you've used the service, but you just haven't paid the bill yet.
The most common example you'll see everywhere is employee wages. Your team works the last week of January, but payday isn't until February 5th. Well, to tell the true story of January's costs, you have to make an adjusting entry to record that wage expense in January, because that's when the work was done.
Okay, so once all our edits, all our adjusting entries are finally done, it's time to publish the story. And this story comes in the form of your financial statements. But what's so cool is that these aren't just separate documents. They're all deeply connected chapters of one single flowing narrative.
And right here is where you see it all come together. Just watch the flow. The bottom line from your income statement, your net income, that's the main character. It moves directly into the statement of stockholders' equity, and it updates a key section called retained earnings. Then that final equity number becomes a cornerstone of the balance sheet. See? It's a completely seamless story, with each part building on the last.
So the story of this period has been told. But you know, every good chapter needs an ending. In accounting, we call this the closing process. You can think of it as the epilogue that officially wraps up this period and gets us totally ready to start fresh on the next one.
Now, to understand this epilogue, you have to know there are 2 types of characters in our financial story. First, you've got temporary accounts, things like revenues and expenses. Their story is only about this one period, so at the end, their balances have to be reset to 0. Then you've got your permanent accounts, your assets, liabilities, and equity. Their story is the company's ongoing journey, so their balances carry forward into the next chapter. And really, the whole point of this, as the source material says so clearly, is just to get those temporary accounts back to 0. It's like wiping the scoreboard clean after a game so you can start the next one totally fresh. And the process itself? It's really just 2 simple steps. First, you take all the revenues from the period and you close them out, adding their total to that permanent account we mentioned called retained earnings. Second, you do the same with all the expenses, but you subtract their total from that same retained earnings account. What you're left with is the net result of this chapter, the profit or loss, and now it's officially part of the company's long-term story. And just like that, poof, the temporary accounts are back at 0. The chapter is officially closed. All the plot points of this period, its profits and its losses, they're now a permanent part of the company's history. And we are ready to start writing the next month's story on a brand new, clean page.
So, from recognizing your revenues and expenses the right way, to making those super important adjustments, and finally to closing the books, every single step is about one thing: making sure the story your financials tell is the true one. And that leads to the final and most important question. Now that you know the rules of financial storytelling, what story are yours telling? Have you ever really stopped to think about what happens to your money right after you buy something? I mean, it doesn't just poof into a company's bank account. It actually kicks off this whole fascinating financial journey. So today, we're going to follow the money. We're going to trace that journey step by step and see how one simple purchase can ripple through a company's entire financial story.
All right, so this is the big question that drives everything, right? When a company sells you something, let's say for $100, what actually happens to that $100? Where does it go? How does the company count it? And is the company's real revenue even $100 to begin with? Well, let's find out. So our journey has to start at the place we all know best, the moment of the sale. But in the world of accounting, the number you see on the price tag, that's almost never the final story.
That's right. That initial sales price is what accountants call gross sales. But that big, impressive number almost immediately starts to get whittled down before it can ever be reported as the company's true revenue. And it shrinks for a few really common reasons.
I mean, think about it from your own experience. Sometimes you return something, boom, that's a sales return. Or maybe a product arrives a little banged up, and the company gives you a small refund to keep it. That's a sales allowance. And some businesses, especially those that sell to other businesses, will even offer a sales discount if their customers pay their bills early. Each one of these things chips away at that original sale amount. So after you subtract all those returns and allowances and discounts from the gross sales, you're finally left with the number that really matters, net sales. This is the number that truly reflects what a company has actually earned, and it's the real starting line for understanding how well that company is actually doing.
Okay, but things get a little more complicated, right? Not every sale is a simple cash-on-the-spot transaction. A lot of the time, especially in business, companies sell on credit. And that's basically a promise to pay later, which adds this whole new layer of complexity and, risk to our product's financial story.
So, when a company sells something on credit, it creates an account called accounts receivable. The easiest way to think about this is just a big pile of IOUs from all its customers. And what's interesting is that on the company's books, this is actually an asset. It's money they have a right to and fully expect to receive in the near future.
And here it is. This is the big risk. What if some of those IOUs are never actually cashed in? What if a customer just can't pay their bill or won't? This is a huge, constant problem for businesses, and they absolutely have to plan for it.
So smart companies, they don't just sit around and wait for people to not pay them. They use a strategy called the allowance method. Basically, at the end of a period, they look at all their IOUs and they make an educated guess. They ask, realistically, how much of this money are we probably never going to see? Then they go ahead and record that estimated amount as a bad debt expense. It's kind of like a financial safety net they build for themselves. So how in the world do they make that guess? Well, they use this really clever tool called an aging of accounts receivable. It's basically a risk chart. They sort all of their customer IOUs based on how late they are. And the logic behind it is super simple but really powerful. The older a bill gets, the less likely it is that it's ever going to get paid. So they might estimate only a tiny percentage of recent bills will go bad, but a much, much larger percentage for the ones that are, say, 90 days overdue. Okay, so we've followed the money that's supposed to be coming in, but that's only half the story. To make that sale, the company had to give something up, a product, and that product had a cost. Now we have to figure out how to account for that.
This brings us to a huge concept, cost of goods sold, or COGS for short. Now, this isn't the price the customer paid, not at all. This is what the company itself paid for the item that just went out the door. And when you subtract COGS from your net sales, you get a company's gross profit, and that's the first real signal of how profitable its main business actually is.
This slide really maps out that whole journey perfectly. For a company that makes things, the costs start with just raw materials. As those materials are being turned into something, they're called work-in-process inventory. And finally, you get finished goods inventory. Now, all this time, the value of that inventory is sitting on the company's books as an asset. But, and this is the key part, the second a sale happens, that cost moves. It literally transfers from being an asset on one financial statement to being an expense, the cost of goods sold, on another, all to match it up against the revenue it just helped create.
All right, so we've dealt with the sale, and we've dealt with the cost of the item that got sold. But what about all the stuff that didn't get sold? All those products just sitting there in the stockroom? Well, we have to figure out exactly what they're worth.
This unsold inventory is another company asset. But here's where things get really tricky. Let's say a company bought the same exact product at different prices throughout the year, because of inflation. Which cost do you use for the items that are still sitting on the shelf? This one question leads to a massive accounting decision.
So to solve this, companies basically have to pick a lane. They choose an accounting method, and the two most common are FIFO and LIFO. FIFO stands for first in, first out, and it just assumes you sold your oldest stuff first, kind of like how a grocery store pushes the oldest milk to the front. LIFO is the opposite, last in, first out. It assumes you sold your newest inventory first, kind of like taking from the top of a pile of sand.
Okay, let's make this real with a simple example here. We've got a bookstore, and the price they pay for books is going up. Now, under FIFO, they assume they sold the cheaper, older books first. What does that mean? A lower cost of goods sold, and therefore a higher reported profit. But under LIFO, they assume they sold the more expensive, newer books. That means a higher COGS and a lower reported profit. Now just stop and think about that for a second. The bookstore sold the exact same number of books and has the exact same books left on the shelf. But just by picking a different accounting method, it reports a totally different profit. How wild is that?
And look, this isn't just some game for accountants to play. This single choice has massive, real-world consequences. It directly changes the profit a company shows to its investors, and maybe even more important, it can change the actual amount of tax the company has to pay to the government. So here's the bottom line, and it's a big one. When prices are rising, like they often are, choosing LIFO means you're expensing your most expensive inventory first. That leads to a higher cost of goods sold, which means lower reported profits and, here's the punchline, a lower tax bill. So the accounting method a company picks isn't just paperwork. It can literally save or cost a company millions of dollars in taxes.
And there you have it. In just a few minutes, we followed a single product's entire financial life. We saw how its price tag was transformed into net sales, how our customers' promise to pay created accounts receivable, how the product's own cost became the cost of goods sold, and finally, how even the stuff left behind in the stockroom has a really important story to tell.
So it really leaves you with a powerful question, doesn't it? If one little choice like FIFO versus LIFO can so drastically change a company's profit and its tax bill, what other choices, buried deep inside those financial reports, are shaping the numbers that we see every single day? It just goes to show you, understanding a business isn't just about looking at the final number. It's about knowing which questions to ask to figure out how they got there in the first place.
Hey everyone, welcome. You know, when a company drops its latest earnings report, it's kind of like getting their report card, right? It shows us how they've been doing. But have you ever wondered what really goes into creating that report card? And whether it's telling us the whole story? Well, that's exactly what we're going to find out. Because really, that's the big question, isn't it? Is that final number, the one that makes all the headlines, a perfect snapshot of reality? Or is there a little more going on behind the curtain? We're going to peel back the layers and take a look. So first things first, it's not like one person just cooks up these numbers and signs off. No way. There's a whole system of gatekeepers and referees, all designed to make sure the information we, the public, get is actually reliable. Let's meet the key players in this game. And it all starts right at the top. I'm talking about the Chief Executive Officer and the Chief Financial Officer. They are the ones who are ultimately on the hook for the financial statements. The buck absolutely stops with them. When they sign off, they're saying, yep, these numbers are a fair look at how our company's doing. But here's the thing. Management doesn't get to just make up its own rules. There's a whole system of oversight. At the very top, you've got the SEC. Think of them as the top cop on the beat, looking out for investors. The SEC then empowers the FASB to actually write the official accounting playbook. You've probably heard of it, GAAP. And then there's the PCAOB, and their job is to police the police. They make sure the auditors are playing by the rules when they check a company's math. So you can see there's a really structured flow to all this. Management puts together the report card. The board's audit committee, who work for the shareholders, by the way, is looking over their shoulder. Then, an outside, totally independent auditing firm comes in to give everything a deep dive, checking it against the rulebook. It's only after all those steps that the final report gets released to you and me. Okay, so we know who's in charge of making the report. Now, let's do the fun part. Let's actually crack one open and see what we can learn from the numbers themselves. And this is a perfect example of what a real-world report card looks like. This one's from Apple. You can see that massive number right at the top, net sales. That's all the money pouring in from iPhones, MacBooks, all of it. Then, after you subtract all the costs of running the business, you get down to that famous bottom line, net income. In other words, the profit. And right below that big profit number, you'll almost always see this little acronym, EPS, or earnings per share. Now, this metric is a huge deal. Why? Because it takes that giant net income number and boils it down to something an individual investor can actually relate to. It answers a simple question. For every single share of stock I own, how much profit did the company actually make? But here's the thing. Just looking at raw profit, it's not enough. We also want to know how efficient a company is. How good are they at using the stuff they have to actually generate that profit? And that's where a really key performance metric comes into play. And one of the best tools for the job is called return on assets, or ROA. Now don't let the formula scare you. All it's really asking is a simple question. And we can break ROA down into two simple little engines that make it work. On one side, you have profit margin. That's all about profitability. How much profit are you squeezing out of every single sale? Then on the other side, you have asset turnover. This is all about efficiency. How fast can you use your assets to make those sales? A truly great company, they're usually firing on all cylinders in at least one of these areas, if not both. All right, we've met the players, we've got the key stats, but this is where our little investigation takes a fascinating turn. Because the numbers you see on the page, well, they aren't always as black and white as they seem. There's a real art to how they're presented. This right here is the formal definition of something called earnings management. And I want you to notice that key word, judgment. Accounting isn't always just 2 + 2 = 4. It involves a lot of estimates, a lot of choices. And management can use that judgment to, well, to paint a slightly different picture, either to mislead people or just to hit certain targets. And they basically have two main ways to do this. On the left, you've got real earnings management. This means changing actual real-world business decisions just to hit a number. On the right, you've got accrual manipulation. This is more subtle. It's all about playing with the accounting estimates and assumptions. Let's look at a few examples. Okay, so for real earnings management, think about this. A company might rush to ship a bunch of products out the door on the last day of the quarter just to book that revenue, even if it costs more to do it that way. Or they might offer crazy discounts to pump up sales, which could hurt their profits down the line. They might even cut spending on super important things like R&D just to make the short-term profit number look a little prettier. Now, accrual manipulation. This is a bit sneakier. It happens entirely on a spreadsheet, not in the factory. For example, every company has to estimate how many of its customers just aren't going to pay their bills. If they suddenly decide to lower that estimate, boom, reported profit goes up on paper, even though not a single extra dollar of cash came in. It's all about tweaking the assumptions that are allowed within the accounting rules. I know, this probably all sounds a little shady, right? So that leads to the really big question. Why? Why would a company's leaders do this? What are the motivations behind it all? Well, it turns out there are some pretty powerful incentives. A higher stock price, that's good for everybody. Executive bonuses are very often tied directly to hitting specific earnings targets. And sometimes a company has loan agreements with its bank that say they have to stay above a certain level of profit. If they dip below that, it could cause huge problems. So the pressure to hit the number can be absolutely immense. But here's where it gets really interesting. It all depends on your perspective. From where we stand as investors, any kind of manipulation that hides weak performance feels, bad. But from inside the company, they might see it very differently. They might not even call it manipulation. They might call it earnings smoothing, just presenting a stable, predictable picture to the market to avoid causing a panic or to keep from breaking a loan agreement that could really hurt the company. So, what's the big takeaway here? It's not that financial reports are useless or that you can't trust them. Not at all. They are incredibly valuable. The key is that you have to read them with a critical eye. You have to understand that, yes, there are strict rules, but there's also a little bit of wiggle room for judgment and strategy inside those rules. So I'll leave you with this. The financial statements, that's the playing field. The numbers, that's the ball. And now you know the rules of the game. So the next time you look at a company's report card, you can ask the real question. Are they just playing the game, or are they trying to bend the rules? Thanks for tuning in. Today, we're going to crack the code on what is basically the universal language of money. In our global economy, every single business tells a story with its numbers. But what happens when they're all speaking different dialects? Well, it creates confusion, risk, and a ton of missed opportunities. So let's figure out how we can all get on the same page. It really all boils down to this one question. If you're an investor and you're looking at a tech firm in Silicon Valley and another one over in Berlin, how do you make a real apples-to-apples comparison? Sure, their financial reports might look similar, but the rules they follow to build them can be fundamentally different. So, here's our game plan. First, we'll talk about why we even need rules in the first place. Then, we're going to break down the two major accounting systems. You've probably heard of them, GAAP and IFRS. After that, we'll look at the global push to bring them closer together, we'll take a peek inside a company's annual report card, and finally, we'll meet the watchdogs who make sure everyone is playing fair. Think about it like any sport.
Without a clear set of rules, the game would just be chaos, right? You'd have no idea who's winning or if anyone's cheating. Well, business is exactly the same. It needs a rulebook to ensure everything is fair, transparent, and comparable for everyone involved, from the investors all the way to the managers. And what is that rulebook? Well, it's made up of what we call accounting standards. These are the official nuts and bolts guidelines for everything. I mean, how a company recognizes its revenue, how it values its assets, how it reports profit. Without these standards, a company's income statement wouldn't mean much, because you'd have no idea what rules they use to come up with that number. Now, it used to be that there were tons of different local standards all over the place. But over time, the world of international business has pretty much consolidated around two main sets of rules, two dominant financial languages, if you will. And understanding these two is absolutely key to understanding global finance today. And that brings us to the two heavyweights on the world stage, GAAP and IFRS. Now, on the surface, they're both trying to do the same thing, create transparent financial reports. But as you're about to see, they come at it from two very different philosophical angles. First up is GAAP. That stands for Generally Accepted Accounting Principles. This is the standard used right here in the United States. It's put together by the Financial Accounting Standards Board, or FASB, and let me tell you, it is known for being incredibly detailed. Its global counterpart is IFRS, the International Financial Reporting Standards. This one is issued by the International Accounting Standards Board, and it's the required standard in over 140 countries. We're talking the European Union, Canada, Australia, which makes it the most widespread system on the planet. Okay, this right here gets to the absolute heart of the difference between them. GAAP is what we call rules-based. Think of it as a massive instruction manual that tries to give you specific, detailed directions for every possible situation, leaving very little room for you to interpret things on your own. IFRS, on the other hand, is principles-based. It sets out broad principles and then trusts the professional judgment of accountants to apply them correctly. It's really the difference between a 1,000-page legal code and a short, guiding constitution. For instance, a U.S. company using GAAP can value its inventory with a method called LIFO, or last in, first out. But under IFRS, that method is completely banned. So same company, same inventory, different rules, and potentially a very, very different reported profit. So, with these major differences, it's probably no surprise that there's been this huge global effort to try and harmonize these standards. This whole movement is known as convergence, and the ultimate goal is to narrow the gap and maybe one day create a single, high-quality set of global accounting rules for everybody. This whole convergence thing is happening in a few different ways. You've got some countries that have just gone all in and adopted IFRS for all their companies. Then you have others that take a more flexible route. You know, they let companies choose between IFRS and their own local standards. And a third group, they stick to their own rules, but they allow foreign companies on their stock exchanges to use IFRS. So, after all these rules are applied and the accountants have done their work, what does the final product actually look like? Well, that brings us to the annual report. This is the company's yearly financial scorecard, where it tells its story to the entire world. It's so important to understand that these reports are not just some random collection of numbers. Not at all. They follow a very specific structure that is dictated by the accounting standards we've been talking about, whether it's GAAP or IFRS. This common format is absolutely crucial because it means investors can find the information they need in a predictable place, no matter what company they're looking at. For a private company, the report usually has three main parts. First, you've got the four basic financial statements: the balance sheet, income statement, cash flow statement, and the statement of owner's equity. Then you have the footnotes, which provide all the critical details and context. And finally, if the report's been audited, you'll see the independent auditor's opinion on whether it's all fair and square. Now, if a company is publicly traded, they have to go even further. In the U.S., they're regulated by the Securities and Exchange Commission, the SEC. They have to file a much more detailed document called a Form 10-K. This has everything the private report has, plus a section called Management's Discussion and Analysis, where the leadership team explains the results, and you also get a 5-year summary of financial data for some historical perspective. Okay, this all sounds great in theory, but who actually makes sure that companies are following these rules correctly and not just, making things up? Well, that brings us to our final section, the guardians of the code. The cool thing is, there isn't just one single watchdog. Instead, there's a whole system of checks and balances designed to protect the integrity of financial reporting. And this involves everyone from the company's own top brass to external auditors and government regulators.
and accountability starts right at the very top. In the U.S., thanks to the Sarbanes-Oxley Act, the CEO and CFO can't just claim they didn't know what was going on. They have to personally sign off on the financial reports, certifying that they are accurate. This puts direct, personal responsibility squarely on their shoulders. There's no passing the buck. So here's kind of how that accountability chain works. First, you have management. They have the primary responsibility. Then, an independent auditing firm is brought in to scrutinize the books and give an objective opinion. The company's own board of directors, specifically their audit committee, oversees this whole process. And then, for public companies, the SEC is the ultimate authority with the power to enforce all the rules. So, why does any of this matter to you? Well, because when you understand the rules of the game, whether it's GAAP or IFRS, you can look past the flashy headlines and read the real story a company is telling with its numbers. You can make smarter comparisons, ask much better questions, and just become a more informed investor, employee, or even citizen. Which leaves us with one final thought to chew on. As our economies become more and more connected, is the move toward a single, unified set of global accounting standards not just a nice goal, but an actual inevitability? Something to think about. Thanks for tuning in.
All right, let's dive right in. Today, we're going to pop the hood on a company's finances and really look at how they account for their biggest, most important possessions. You know, the stuff that's built to last.
So let me ask you a question. When you think about what makes a company valuable, what's the first thing that pops into your head? Is it just a pile of cash? Maybe all the products sitting in a warehouse? Well, the real answer is so much more interesting, and it involves everything from giant factories to ideas that can literally change the world.
Here's our game plan. First, we'll nail down exactly what these long-lived assets are. Then, we'll get into the three main types: the stuff you can touch, the stuff you can't, and the stuff we get from the earth. And finally, we're going to connect all the dots and see why this stuff is absolutely crucial for understanding what a company's truly worth.
So let's start with the big picture. What are we really talking about when we say long-lived assets?
Okay, in the simplest terms, these are the heavy hitters. They're the big-ticket items a company buys for the long haul, not to just flip them for a quick buck. Think about a delivery company's entire fleet of trucks, or the massive campus a tech giant builds. This is the bedrock the business is built on.
Now, these assets really fall into three main buckets. First, you've got your tangible assets, the stuff you can physically kick the tires on. Second, intangible assets. These are super valuable ideas and rights. And third, you have natural resources, things we literally pull out of the ground. Let's take a look at each one.
First up, let's talk about that first category, the physical backbone of a company. You'll often hear accountants lump it all together as property, plant, and equipment.
The definition here is pretty intuitive. Tangible assets have physical substance. We're talking about the land a factory's sitting on, the building itself, and every single machine whirring away inside. These are probably the most obvious signs of how a company is investing in its future.
But what about the money a company spends on these things after they've already bought them? Well, there's a really crucial difference here. Just regular maintenance, fixing a broken part on a machine, that's just a normal everyday expense. But an improvement, like upgrading a machine's engine to make it way faster and more efficient, that's totally different. That cost actually gets added to the asset's value because you fundamentally made it better.
And this brings us to a huge concept: depreciation. See, instead of taking the massive hit of a new machine's cost all in 1 year, companies get to spread that cost out over the machine's useful life. It's a way to match the expense of having the asset with the money it helps bring in. Now, the one big exception here is land. Land isn't depreciated, basically because it's assumed to last forever.
And get this, there isn't just one way to do it. The most common method is straight line, where you just expense the same amount every single year. Simple. Then there's units of production, which is based on how much you use it. Think of a truck. The more miles it drives, the more it depreciates. And finally, you've got the declining balance method, which lets you take a bigger expense hit up front. A company might pick one over the other for all sorts of reasons, from tax benefits to making their earnings look smoother.
Okay, so we've covered the solid stuff, the things you can see and touch. But what about a company's most powerful assets, the ones that are completely invisible? This is where we get into the really fascinating world of intangible assets.
The value here isn't something you can hold in your hand. It's all about rights, ideas, and intellectual property. We're talking about things like patents that protect a brilliant new invention, trademarks that protect a brand's famous logo, or the goodwill a company earns from having a fantastic reputation. Honestly, these can often be a company's most valuable possessions by a long shot.
So where does the value come from? It's all about the specific legal rights these things give their owner. A patent, for example, gives a company a 20-year monopoly to make and sell an invention. No one else can touch it. That kind of legal shield can be worth billions.
So how do accountants handle the cost of these invisible assets over time? Well, the process is called amortization. I know it's a fancy word, but it's basically the exact same idea as depreciation. It's just the term we use for intangible assets, like a patent or a copyright, that have a clear, limited lifespan.
But wait a second, not all of these things have an expiration date. What about a brand's amazing reputation, its goodwill? Since that could theoretically last forever, you don't amortize it. Instead, companies have to check it every single year to see if its value has dropped. It's a process called an impairment test.
Okay, on to our third and final category, assets that we literally pull from the ground.
For assets like oil reserves, coal mines, or huge forests of timber, we use another special word, depletion. And it's the perfect word for it, right? It perfectly describes what's happening. As a company pulls that resource out of the ground and sells it, the value of the asset on the books gets depleted. It's just the natural resource version of depreciation.
We've covered a ton of ground here. Tangible, intangible, natural. So let's bring it all home and talk about why any of this actually matters.
So we've got these three different names: depreciation, amortization, and depletion. It might seem complicated, but they all share one single fundamental goal: to match the cost of an asset with the period of time when that asset is actually helping the company earn money. It's the same core idea, just with a different label for each type of asset.
So why does all this matter? I mean, really? Because this is so much more than just a bunch of boring accounting rules. Understanding this stuff lets you read the real story behind a company's numbers. It shows you exactly where a company is placing its bets for future growth, and it helps you get a much clearer picture of its long-term financial health.
And this all boils down to a critical number you'll see on a company's balance sheet: net book value. It's super simple. You take the original price tag of an asset and you subtract all the depreciation that's been piled up against it over the years. That number gives you a snapshot of what that asset is worth, at least according to the company's books.
And that leaves us with one last really fascinating question. You see, accounting has all these strict rules for valuing things. But what about the value of a famous brand name that was built from scratch over, say, 50 years of hard work? In most cases, that immense value, it doesn't show up on the balance sheet at all. It makes you wonder, doesn't it, how much of a company's true worth is left completely invisible by the very rules that are supposed to measure it. Welcome to The Explainer. Today, we are talking about a financial tool that can literally build empires or bring them crashing down. I'm talking about debt. Now, in the business world, it goes by another name, a liability. And trust me, understanding what that means is absolutely key to figuring out how our whole economy ticks. Let's start with something you probably know really well. Have you ever used a credit card? Or maybe taken out a student loan? Well, if you have, then you've dealt with a liability. It's that simple. You're using someone else's money with a promise to pay it back later.
Well, it turns out companies do the exact same thing, just on a massive scale. Think about it. From your local coffee shop buying beans to the biggest tech companies on the planet building new data centers, they all borrow money to operate and grow. And every time they do, poof, a liability is created.
Okay, so what is a liability really? The textbook definition can sound a little stuffy, but it all boils down to something super simple. It's a formal IOU. That's it. It's a debt the company owes to someone on the outside, could be a bank, a supplier, you name it, and they have to settle that debt down the road.
All right, so now that we know what it is, let's break this down into two big buckets. We're going to start with the short-term stuff, the day-to-day debts that are like the engine oil keeping the business running smoothly. And the way we split them up is super simple. It all comes down to one thing: time. You've got your current liabilities. Think of these as the sprint. They're debts that have to be paid off within 1 year. And then you have long-term liabilities. That's the marathon. These are obligations that can stretch out for years, sometimes even decades. So the most common type of short-term liability you'll see is something called accounts payable. The easiest way to think about this, it's basically the company's running tab. When a business buys its supplies or inventory on credit, that IOU sits in accounts payable until they cut the check. But it's not just about paying suppliers. There are other short-term IOUs too.
For instance, what about the salaries a company owes its employees for work they've already done? That's called an accrued liability. Or, get this, if you pay for a year-long subscription to something the company now owes you, that's called deferred revenue. And of course, you've got your classic short-term bank loans, which are called notes payable.
Okay, but here's a tricky one. What happens when a liability isn't a sure thing? This is what we call a contingent liability. It's a potential debt that might pop up in the future depending on how something else turns out, like, say, the outcome of a lawsuit. It's a big what if, but companies absolutely have to account for it, even if they don't know for sure what's going to happen.
Okay, so we've covered the sprint. Now it's time to zoom out and look at the marathon, long-term liabilities. And these are the big ones, the major financial commitments that really define a company's future for a long, long time.
And a huge piece of this puzzle is leasing. I mean, think about it. Most big companies don't actually own all their buildings or their fleets of vehicles. They lease them. But here's the crucial question for the accountants. Is that lease just a simple rental expense? Or is it something bigger, more like buying the thing on a payment plan?
Well, there's actually a 5-point checklist accountants use to figure that out. And as you can see right here, if a lease ticks any of these boxes, like say the company gets to keep the thing at the end, or the lease covers most of its useful life, then boom, it's treated as if they bought it. It becomes a long-term liability on the books, not just another monthly bill.
All right, now let's talk about the heavy hitters. What happens when a company needs to raise some serious cash? We're talking millions, even billions of dollars, to do something huge, like build a new factory or buy another company. Well, very often they enter the world of bonds.
So you might be wondering, why issue bonds? I mean, that's just more debt. Why not just sell more stock, more ownership in the company? Well, there are two huge reasons. First, when you take on debt, you don't give up any control. The original owners stay in charge. And second, and this is a big one, the interest they pay on those bonds is tax deductible. That can save them a ton of money.
And the process itself is actually pretty simple when you break it down. Step 1, the company issues these bonds to investors. Step 2, the investors buy them, and the company gets a big pile of cash right away. Step 3, in exchange, the company pays those investors regular interest payments. We call these coupon payments. And then Step 4, at the very end of the loan, the company pays back the original amount they borrowed, which is called the principal. Pretty neat, right?
So, that interest rate I just mentioned, that's called the coupon rate, and it is absolutely crucial. It's the fixed interest rate that gets locked in the day the bond is created, and it tells you exactly how much cash an investor is going to get paid every single year. And, not all bonds are created equal. They come in all sorts of flavors. You've got secured bonds, which are backed by actual company assets, so they're a bit safer. Then there are unsecured bonds, sometimes called debentures, which are really just backed by the company's reputation and promise to pay. And some even have this cool feature where you can convert them into company stock down the line. Lots of options.
Now here is where it gets super interesting. Just because a bond is issued with a certain face value doesn't mean its price stays there. After it's out in the world, its price is in this constant tug-of-war between its own fixed interest rate and whatever the current market interest rates are doing.
This table here breaks it down perfectly. Think about it. If newer bonds on the market are paying a higher interest rate than your old bond, nobody's going to pay full price for yours, right? So it sells at a discount. But if market rates drop and your bond is paying a better rate than the new ones, well, now it's a hot commodity, and it'll sell for a premium, more than its face value. And if the rates happen to be the same, it sells at what we call par.
Okay, wow, we've covered a ton of ground here, right? From the little day-to-day IOUs all the way up to billion-dollar bonds. So, what's the big picture? Why should you actually care about any of this?
Well, it all comes down to one incredibly important word: liquidity. Liquidity is basically a snapshot of a company's financial health. It asks a very simple but very serious question. Does this company have enough cash on hand to pay its bills that are due right now? Because honestly, if the answer is no, it doesn't matter how amazing their product is, they are in big trouble.
And the main way analysts measure this is with a metric called working capital. It's a simple formula. You just take all the company's current assets and subtract all its current liabilities. If you get a positive number, that's usually a good sign. They've got enough to cover their short-term debts. But a negative number? Whoa, that can be a huge red flag that the company might be in financial hot water.
And the scale we're talking about here is just mind-blowing. The market for corporate bonds alone is worth well over $100 trillion globally. So you see, getting a handle on liabilities isn't just some boring accounting exercise. It's about understanding the engine room of the entire global economy.
Which brings us back to where we started. In the end, that's exactly what a liability is: a powerful tool.
In the right hands, it fuels incredible growth and innovation. But in the wrong hands, it can lead to disaster. It is a constant, high-stakes balancing act that every company has to navigate.
So, I'll leave you with this thought. The next time you look at a company and see it has a lot of debt on its books, what do you see? Is it a warning sign of a company taking on way too much risk? Or is it a sign of ambition? A company that's borrowing big because it plans to build the future? The answer? Well, it's never quite that simple, is it?
Have you ever stopped and wondered what a corporation really is? It can seem like this huge, complicated idea. But you know what? Today, we're going to peel it back, layer by layer, just like an onion. We're going to start right at the core, what a company legally is, and work our way out through stocks, dividends, and all the way to those massive corporate mergers you hear about. By the end of this, you'll see exactly how it all clicks together. Yeah, we throw these words around all the time, right? Stocks, corporations, but what's the actual deal with them? When you buy a share of some company, what are you really getting your hands on? Let's break it down, starting with the absolute fundamentals. All right, let's get right to the center of our corporate onion. Before we can even begin to talk about stocks or anything else, we have to get a solid grip on what a corporation is. This one idea, this single concept, is the foundation for, well, everything else. So here it is, the most important idea of all. A corporation is what's called a separate legal entity. The best way to think about it is that the law sees the corporation as its own person. Seriously, it can own stuff, it can get into debt, it can sign contracts, and it's all completely separate from the people who own it. This legal shield is, no exaggeration, what makes the modern business world go round. And who are these owners? Well, that's where stockholders come in. If you've ever bought even a single share of a public company on an app or through a broker, then guess what? Congratulations, you are officially a part owner of that business. You're a stockholder. Simple as that. So what do you actually get for being an owner? It really comes down to three key things. First, you get a vote. You have a say in big company decisions. Second, you can get dividends, which is just a fancy way of saying you get a piece of the profits. And third, if the company were to, sell everything off, you get a claim on whatever's left after all the debts are paid. And these ideas, the company as its own person and the rights of the people who own it, this is the bedrock of corporate finance. Everything we're about to talk about is built right on top of this foundation. Okay, let's move on to the next layer of the onion. Now that we know what a corporation is and who a stockholder is, let's dig into the different ways you can own a piece of a company. This is where we get into the real building blocks of equity.
So it turns out not all stock is the same. The two big categories are common and preferred stock. And really, there's a clear trade-off between them. With common stock, you get voting rights. You get a voice in how the company is run. But with preferred stock, you usually give up that vote. So why would you do that? Because you get priority. You are first in line to get paid dividends, and those dividends are usually a nice, predictable, fixed amount. Now, we've said the word dividend a few times, so let's be super clear. A dividend is just the company sharing its profits directly with you, the owner. It's cash in your pocket. And for a lot of investors, a company that pays a regular, steady dividend is seen as a sign of a really healthy, stable business. But how does that money actually get from the company to you? Well, it's a neat three-step dance. First is the declaration date. That's when the board of directors makes it official and says, yep, we're paying a dividend. Next is the date of record. On this day, the company basically takes a snapshot of everyone who owns the stock. If your name is on that list, you're getting paid. On the third and final day, the payment date. It's a very organized process.
Okay, so far, we've been looking inside just one company. Now, let's zoom out. Let's peel back another, much bigger layer of the onion and see what happens when companies themselves start buying stock in other companies. This is where you get a whole web of corporate relationships. This really is the crucial question when one company invests in another, isn't it? How much do you need to own to actually have some clout? Is 1% enough? 10%? Where do you draw the line between just being an investor and actually having some influence? Well, the financial world has some pretty clear lines in the sand. If you own less than 20%, you're pretty much considered a passive investor. But once you cross that 20% mark, all the way up to 50%, you're considered to have significant influence. And if you own more than 50%, game over. You're in control. And these aren't just labels. They completely change the accounting rules and how these companies have to report their relationship to the world. Let's just walk through that real quick. Below 20%, it's a simple investment. But the moment you cross into that significant influence zone, the accounting gets way more involved to show that closer link. Then, past 50%, you have control. And at that point, you have to do something called consolidation, which basically means you merge their financial statements into your own. Each step up is a much, much deeper level of financial connection.
And that brings us to the very outermost layer of our corporate onion. This is the ultimate expression of corporate control, when one company just goes ahead and buys another one entirely. We're talking about mergers. I mean, think about it. This is a massive, incredibly expensive, and complicated thing to do. So why bother? What is the strategic logic behind these multi-billion-dollar deals we see in the news? Well, it usually comes down to a few key reasons. One is vertical integration. That's like a car company buying a steel mill to control its raw materials. Then you've got horizontal growth. That's buying your direct competitor to get a bigger piece of the market pie. But the one you hear about all the time, the big buzzword, is synergy. Synergy is that classic idea that 1 + 1 = 3. It's the belief, or maybe the hope, that if you combine two companies, you merge their technology, you cut out overlapping costs, you get into new markets, that the new, bigger company will be way more profitable than the two were on their own. It's the #1 justification for almost every huge deal out there. So we've done it. We've peeled the corporate onion from the tiny core all the way out to the tough outer skin. Now let's put it all together and talk about the big takeaway here. So why does any of this stuff matter? Because these aren't just abstract ideas in a textbook. This is the language of business. The next time you see a headline about a corporate merger, you'll know to ask, okay, why are they doing this? Is it for synergy, vertical integration? You're not just reading the news anymore. You're seeing the strategy playing out right in front of you. So the next time you glance at a stock price, don't just see a number on a screen. See the onion. Ask yourself, what's going on inside? Is there a dividend coming up? Did a big investor just cross that 20% line? Because behind every single number, there's a story. And now, you know how to start reading it.
All right, let's dive in. Today, we're basically becoming financial detectives. We're going to learn how to look right past all the noise and the hype and use financial analysis to uncover the real story, the one that's hiding inside a company's numbers. So here's the big question, right? It's the central mystery every investor tries to solve. You see a stock price just skyrocketing, but what's actually happening behind the curtain? Well, think of financial analysis as our investigation. This is how we sift through all the evidence to figure out what's real and what's just fiction.
You know, any good detective will tell you, you don't just rush into a crime scene looking for fingerprints. No. First, you take a step back. You survey the entire scene to get the context. And you know what? In financial analysis, it's the exact same idea. We have to see the big picture before we can zoom in on the tiny details.
That's so true. It's way more than just crunching numbers. In fact, before we even peek at a single financial statement, we have to understand the world that company lives in. Because all those numbers you see on a balance sheet, they're not random. They are the direct result of a company's strategy, its decisions, and the whole economic environment it's dealing with.
Okay, so how do we survey the scene? How do we get that context? Well, we do it by looking at 3 absolutely critical layers. This is how we start to build our case kind of from the outside in.
So here's our approach. We start really broad, looking at the entire economy. Are interest rates going up? Is inflation a problem? Then we zoom in a bit to the specific industry. Maybe it's tech, maybe it's retail. Are there new regulations shaking things up? And only then, after all that, do we put the company itself under the magnifying glass. We look at its products, its leadership, what people are saying about it. Each layer gives us a totally essential piece of the puzzle.
All right, so we've surveyed the scene. What's next? Well, now we have to understand the motive. And in the world of business, the motive is really just the company's core strategy. Why do they do the things they do? Figuring this out is the absolute key to understanding the story their financial numbers are about to tell us.
When you boil it all down, companies really compete in one of 2 main ways. On one side, you've got product differentiators. Think of a luxury car brand, right? They can charge a ton of money because their quality is just seen as being on another level. But on the other side, you've got cost differentiators. Think of a big discount store. They win by being super efficient so they can offer the absolute lowest prices. Knowing which game a company is playing is critical because it's going to shape every single number we look at.
So we've got our context and we understand the motive. Now, it's time to open up our toolkit and actually start looking at the evidence. And there are two main methods we, as detectives, use to compare financial data and spot the really important patterns.
These two methods are how we build our case. First up, there's time series analysis. This is where we look at one company's story over, say, the last 5 years. We're asking, is performance getting better or worse? Then we have cross-sectional analysis. This is where we compare our company to all its rivals right now, at this single moment in time. We're asking, how do they stack up against the competition? And let me tell you, you need both of these perspectives to get the full picture. It's not optional.
And now, for the most powerful tool in our detective kit, financial ratios. Ratios. They're kind of like a secret decoder ring. They take these huge, raw, almost meaningless numbers from a financial statement, and they turn them into powerful clues that let us see what's really going on inside a company.
I get it. Looking at a real financial statement can be pretty intimidating. It's just a wall of numbers. But I promise you, all the clues we need are hidden right in there. The secret is that no single number tells you very much on its own. Ratios are our key. They unlock the story by comparing one number to another. So let's break down the main types of clues they can give us.
First up, we have profitability ratios. These answer the most basic, fundamental question of all. Is this business actually making any money? For example, the net profit margin. It tells us for every single dollar the company makes in sales, how many cents are left over as pure profit after every single expense is paid. A company with a 5% margin is way less successful than a competitor with a 20% margin, even if they have the exact same amount of sales. See how that works?
Next are liquidity ratios. These are all about short-term survival. Plain and simple, can the company pay its bills this month? A business can look really profitable on paper, but it can go bankrupt tomorrow if it doesn't have enough actual cash to pay its suppliers. So we check its pulse with something called the current ratio, which compares what it owns that can be quickly turned into cash versus what it owes in the very near future.
And finally, we look at efficiency with asset turnover ratios. These tell us how well a company is using its stuff, its buildings, its equipment, its inventory to actually generate sales. For a retailer, the inventory turnover ratio is a huge clue. Is stuff flying off the shelves, or is it just sitting in a warehouse collecting dust? A company that's turning over its inventory quickly is using what it owns way more effectively.
Okay, so we've gathered all our clues. We've got the context, we understand the strategy, and we've calculated our ratios. But here's the thing. The numbers themselves, they aren't the answer. The final, and I mean most critical step, is to interpret all this evidence and deliver the verdict.
You see, a single ratio in a vacuum tells you almost nothing. Context is absolutely everything. First, you have to compare it to the industry averages. A really high debt ratio might be terrifying for a software company, but it's totally normal for a big utility company. Second, compare it to the company's own history. Is profitability suddenly dropping? Maybe it's a sign of trouble, or maybe they just invested in a huge new expansion. And finally, you combine all those numbers with the subjective stuff, like, is the management team actually any good? This is where the science of analysis becomes an art.
And that right there is really the heart of it. Being a great financial analyst isn't just about being good at math. It's about being a great storyteller. It's about using the evidence you find in the numbers to piece together a compelling and, most importantly, a truthful story about where a company has been, where it is now, and where it might be going.
So there you have it. The detective's toolkit is now yours. You know how to survey the scene, how to understand the motive, and how to analyze the clues. So the only real question left is, which company's story are you going to investigate first?
You ever see a company reporting these huge, amazing profits and think to yourself, what is really going on under the hood? Well, today we're going to pull out the ultimate diagnostic tool for that, the statement of cash flows. It's the one report that cuts through all the accounting noise and shows you exactly where the money is and where it went. So let's just jump right in with a question that sounds kind of like a trick question. Is it possible for a company that is, on paper, profitable to actually go bankrupt? I mean, it sounds crazy, right? If they're making a profit, they're making money. Or are they? And yep, there's your answer. 100% yes, it happens all the time. See, profit is really just an accounting idea, but going bankrupt, that's a cash problem, plain and simple. A company has to pay its employees, its suppliers, and its rent with cold, hard cash, not with something called net income. And when that cash dries up, The game is over. All right, so here's our game plan for today. First, we're really going to hammer home this idea that profit isn't the same as cash. Then, we'll break down the statement itself, its basic anatomy. After that, we'll dive into the 3 key activities that make up the heart of the report. And finally, we'll learn how to put it all together to read the story the cash is trying to tell us. And this right here is the whole reason the statement of cash flows even exists. You see, the income statement, where you find that net profit number, it's useful for sure, but it can also hide a lot. To get the real picture of a company's health, its actual ability to survive and thrive, you have got to follow the cash. And here it is, a real-world example. This is the actual statement of cash flows for National Beverage Corp. You know, the folks who make LaCroix. At its core, its job is incredibly simple. All it does is tell you how the company's cash balance changed from the start of the year to the end of the year. That's it. It's the story of their year told only through the language of cash. Now, just a quick clarification. When we say cash, we don't just mean physical dollar bills in a drawer. This statement also includes something called cash equivalents. These are things like treasury bills or commercial paper, basically super safe short-term investments that a company can turn back into cash at a moment's notice. The easiest way to think about it is like the company's checking and savings accounts all rolled into one. Okay, I get it. At first glance, a document packed with numbers like this can look a little intense, but it's actually put together in a really logical way. And once you see the structure, trust me, it all starts to click. So, you should know there are 2 ways companies can prepare this statement. But honestly, you're almost always going to see what's called the indirect method. It's kind of clever. It takes the net income number from the income statement as its starting point, and then it makes a bunch of adjustments to work backward to the actual cash that the business brought in. So how does this all come together? Well, imagine an accountant taking 2 snapshots of the company, one on January 1st and another on December 31st. They look at every single thing the company owns and owes, and they figure out what changed. Did they buy more inventory? Did they take on new debt? Then they take every single one of those changes and sort them into one of 3 buckets: operating, investing, or financing. And those 3 buckets, that is the absolute heart of the story. Each one tells a really important and very different part of how the company generated and used its cash over the year. First up, you have operating activities. I like to think of this as the engine room of the company. It's the cash that comes from its main, day-to-day business. For any healthy company, what you really want to see here is a big, strong, positive number. It's the proof that their basic business model actually works and generates cash. Next up, we've got investing activities. Now, this section is all about building for the future. Think of it like the company's spending on big-ticket items. Are they buying a new factory, selling off an old building? So don't be scared if you see a big negative number here. A lot of the time, that just means the company is investing heavily in its own growth. And finally, we have financing activities. This is all about the company's relationship with its funders, its banks and its shareholders. This is where you find the answers to questions like, did they borrow more money? Did they pay back old loans? Did they issue new stock to raise capital? Or did they pay cash out to their owners in the form of dividends? Okay, let's just lay this out real simple. Cash comes in from operations when you sell stuff. It comes in from investing when you sell an old asset, like a building. And it comes in from financing when you take out a loan. On the other side of the coin, cash goes out of operations to pay your employees. It goes out of investing to buy a new building. And it goes out of financing when you pay back that loan. See, it's just a constant flow of cash moving between these 3 main areas. Now, things can get a little tricky here, so there are a few important rules you just got to remember. When a company pays back a loan, the big chunk of that payment, the principal, is a financing activity. But the interest they pay on that loan, well, under U.S. rules, that's considered an operating activity. And paying dividends out to your shareholders, that's a financing activity too. It's seen as returning capital to the owners.
All right, so we've got the basic structure down. We know what goes into each of the 3 buckets. Now for the fun part, putting it all together to actually read the story and figure out how healthy a company really is.
So let's circle back to our National Beverage example. When you add up all the cash that came in and all the cash that went out across all 3 activities, you get the bottom line, the final score. And in this case, their total cash pile actually shrank by nearly $33 million. So no matter what their profit number might have said, The reality is, their bank account was smaller at the end of the period than it was at the beginning. And this brings us to a metric that professional investors are completely obsessed with. It's called free cash flow. The idea is actually pretty simple. You take all the cash that the company's main business generated, and then you subtract the essential spending, the money they had to spend on things like new equipment to maintain and grow the business. The number that's left over, that's the free cash the company has to play with. It's the ultimate measure of a company's financial power. So the next time you're looking at a company's financial reports, I'm telling you, don't just stop at that big, flashy profit number. Dig a little deeper, find the statement of cash flows, and ask yourself, where is the cash really coming from, and where is it going? Because at the end of the day, profit is an opinion, but cash is a fact.